Good evening, all, and a very warm welcome to today's webinar. On behalf of NISM, I would like to take this opportunity to welcome you all for today's webinar, which will be on mutual fund direct and regular plans. Myself, Amit Sayed, working with NISM. Along with me, we have today a renowned speaker from the industry who will be taking today's webinar. So we have on board Sanjeeva Mathur, promoter, Syrian Motors. Before we begin, let me give a quick introduction about our speaker. Mr. Mathur has over 30 years of achievement developing B2B and B2C channels in the FSI industry in India and overseas. Sun FNC, Reliance Securities Limited, Cholamandalam AMC, FBSB India, he has worked on. Sanjeeva Mathur is today's passionate advocate of financial planning and actively works to spread financial literacy across the country. He has been sought after external faculty member, known for his incisive lectures on debt and equity markets and other varied aspects of capital markets with National Institute of Security Markets, which is our education initiative of SEBI, IES, ICA, ICLS, and India Revenue Services, Army Group Insurance Fund. Mr. Mathur has also worked with SEBI, SBI, Aditya Birla, ICSI, AMCs, HSBC, White Oak for training of their team members. Sanjeeva holds a master's in chemistry from Delhi University and an MBA from IIM Kozhikode. Before we begin, let me convey you today's topic which we are going to cover. Today we'll be discussing mutual fund direct and indirect plans, regular plans. But before we begin, that mutual funds are typically of two types: investment plans like direct and regular plans. While both of the types of plans invest in the same portfolio of securities, but today our speaker will be discussing more about the difference and their significance in irrespective domains. We'll be taking the questions at the end of the webinar, requesting all the participants to put their queries in the Q&A board. Our speakers will be happy to answer all the questions. So without taking any further time, I would like to hand over the webinar to our speaker. Over to you, sir.
Thank you, Amir, for the fantastic introduction. Good afternoon, everyone. Before I begin, I always have this thing in between. Because I work from home, so network can be an issue. I have multiple network connections to take care of this. So I have both direct and indirect connections out here with me just to put the things in perspective. In case I go offline, I'll log again. Participants are requested to remain online and log back again from a different ID. Okay. Yeah. So this, before I open the presentation, it's a very interesting topic. Because personally, I have been on both the sides. I've been on the distribution side. I've been on the direct side. This has been a matter of debate for quite many years now. Why direct, why indirect, or regular? So I will take you through a presentation. It's a short presentation. We'll take a lot of question answers, but I'll go one by one, the slide stopping, why the need, what is the basic difference, etc. So just give me a second. I'll open the presentation. Just give me a second, please. Now, before I get into the basics of direct and indirect, or regular as it is known as, first of all, as Amir said, there's no difference. The portfolio remains the same. The strategy remains the same. Everything remains the same, whether it is direct or regular. There's no difference in the way, in the objective of the scheme, or way the fund managers investing. The basic difference lies in basically whether you are going through some intermediary, which is known as an advisor or an IFA, that can be a banking channel, that can be individual financial advisor. If you're taking a help of someone, that's a basic difference. To understand direct and regular, we need to first focus on expense ratio. I'll just have a few points. Many of you would be knowing, many of you would not be knowing. The basic difference direct and regular is the expense ratio. That's a basic, a compulsive charge which every mutual fund charges. Whether it is regular or etc., they charge, whether it is an equity scheme or a debt scheme. This is a compulsive thing. I'll just go one by one. The annual fee, which is written in front of the screen, you can read it also. Expense ratio is the annual charge to a mutual investor to cover various expenses. What kind? I'll list that also. Shows expenses as a percentage of total assets. It's a percentage of the assets with the mutual fund has, whether equity or debt. I'll come to that also. Vary depending on management style, size, and asset class, whether debt or equity. Lower expense ratio, higher returns. Why? Because expense ratio forms a part of your net asset value it forms a part of your NAV. So higher the expense ratio, slightly lower the NAV in mathematical sense. TR is total expense ratio to be disclosed on a daily basis, just like every expenses, what are charged, written management fees to cover the cost of running the asset management company. There are there are people there, a lot of expenses. Distribution fee. Now mark these words, commission of mutual fund distributors. You pay something to the distributor, you pay something to the advisor who's helping you choose the right scheme, who's helping you invest in a particular mutual fund scheme. He needs to be compensated. That comes from the expense ratio that is known as a commission. Other expenses, which are forms of part of expense ratio, are legal fees, auditor fees, and other operational expenses. As a formula, the total expense ratio is a total fund cost on the total fund assets, just for the sake of it, I mentioned. Comparing expense ratio for accurate evaluation, compare mutual within similar asset class. See, understand, before I proceed regular direct, people have a mistake. You need to compare mid cap with a mid cap, large cap with a large cap, debt with a particular short-term debt scheme with a short-term debt. You can't be comparing a mid cap with a large cap or a debt with one debt scheme with another debt scheme. You can't do that. Similar type. Analyzed in the context of overall fund performance. Our higher expense ratio may be justified, corresponds to higher quality management or services provided by the investment manager. Let's proceed further. Now, these are the basic expenses. One thing is very clear. I'll read out the chart for you. Expense ratio, SEBI TER limit. As of today, SEBI has laid down certain limits on the expenses you can charge. Why I'm talking about this? Because this will form a very important part when I go further into direct and regular. SEBI total expense ratio limits. They're different for equity. They're different for debt. For equity also, remember one thing. As the assets of a particular mutual fund scheme rises, the TER also falls. So understand, the more the AUM, the lower the TER. So example, the first 500 crores, you can charge with 2.25 for equity, other than equity, 2%. Next 250, 2%, 1.75, and so on. Next 5,000, 1.5, 1.25. Remember, for next 40,000, here's the break-even. For every increase of rupees 5,000 crores of daily net assets, average daily net assets, total expense reduction of 0.05. So the expense ratio will keep falling as the assets rise of a particular scheme of a mutual fund. Base TR's limit for other scheme maximum tier index fund ETFs is much lower, which is written here. For equity oriented 2.25, other equity 2%. These are limits. But repeating again, as the assets rise, the TER falls. Now, debate direct versus regular. I'll simply say people who don't understand the mutual fund fraternity. I was away for 1 week for a historical monument place I was visiting. Now, when I entered inside, they gave me 3 options. You can take a guide. One guide is available just like that, who comes and says, sir, I will show you this. This fort was built in 1647. Here it was happening. One is a certified who carries a, kind of a thing on his neck, etc. List. He's an authorized kind of a person who knows about. He's historical. He has a background. One is that. One is he says, I will give you some audio thing. You can listen to what is happening. Wherever you go, automatically, that's a robot advisor, right? One is a physical advisor. Second is, no, boss, I do not need anybody. I'm good enough. I will go myself. I'm a historical person myself. I know it. Regular and direct. I'll proceed from there. Post 2013, around the mutual fund are asked to segregate between direct and indirect. We call it direct and regular plans. Regular plans, basically you invest through a distributor. There is an advisor in between who shows you the way, who tells you, wait, how do you keep, basically hands hold you. Okay, invest in mutual fund scheme. Distributor charge a commission for the services. This commission is paid by the mutual fund scheme or the mutual fund, which get deducted from the NAV. That's why this is a regular plan. Upfront trail commission paid from, now it's only trail, commission paid from fund assets. Added cost of commission increases the expense ratio, resulting in lower NAV. It basically is paid from the expense ratio So the NAV gets impacted. So lower NAV. Lower NAV means it can have an impact on the return. I will not use the word it eats away the return, because that's not the right way to look at it. It depends. I'll come to the pros and cons later. Direct plan, there is no intermediary, there's no distributor, there's no IFA to invest directly. I prepare for competitive examination, whether engineering, whether MBA, etc. Okay, I prepare myself, I write the exam, I know what to do, what not to do, other than my 12th or my graduation. But sometimes I need to go through some classes, whether it's a quota, whether it's anywhere. I join because they know how to prepare for IIT or any other examination. So they charge an extra fee for that. So that's going indirectly to a distributor. Commission is eliminated as no distributor involved in the case of direct plan. So obviously expense ratio comes down. Expense ratio comes down. Expense ratio forms a part of the NAV. So NAV is higher, which results in a higher return. Example, suppose I invest in one particular mutual fund scheme on day A. Okay, on day A, one same scheme in a regular and direct. After 10 years, the return in the direct plan would be higher because there's no commission. The NAV will be higher because the expense ratio is lower. In the regular plan, because the returns will be lower. But the difference is, because I'm the regular, I'm taking advantage or the expertise of an intermediary to guide me through. I'll come to that also. Popular misconception. Direct plan do not eliminate all costs. They just save on the distribution. Remember, only distribution costs are eliminated. Board and regular plans are subject to other like management fee or fund manager, administrative fee, redemption fee, and other expenses like legal, accounting, and custodian. This doesn't go away, only the commission angle reduces. Direct versus regular comparison. Direct. Buy the fund directly from the AMC, no involvement of the intermediary or the IFA or the any advisory fee. There's nobody. No commission being paid, so NAV is less. Okay, and sorry, NAV is higher because expenses lower. No intermediary means no commission, resulting in a lower expense ratio, which I told you. Savings in commission are passed in the investor in the form of higher NAV. It's given back. Simple in nature, investor is in full control. If you know it, what to do. If you know that I don't need anyone, I can do it myself, go through the direct. Regular plan, buy through a broker who intermediate between investor and AMC. When I say broker, he's an intermediary, he's a guide, he's an advisor. Commission has to pay to the third party, resulting in higher expense ratio. Higher expense ratio means a lower NAV. Investor need to access the option of various third party. Whether you want to go, don't want to go, it's a choice of the investor. Regular plan. Mutual funds are procured through intermediaries like brokers, financial intermediaries, or distributor. It can be a bank, it can be an IFA, it can be a national distributor, regional distributor, anyone. Fund house pay the intermediary a commission or distribution fee. I'm repeating this. Intermediary may also offer added services, including basic investment advice, portfolio evaluation, transaction. When I go to intermediary, he guides me. He makes a goal-based plan maybe for me. He tells me when to invest, what to invest, what's the right way to invest. He's a guide. He's a guide who stands with me in the times of my investment, right? Regular plan contain regular in the, and when you read the fact sheet or the scheme, it will be written clearly regular plan or reg plan, REG short form. Advantages, streamline process. A well-qualified MFD as a mutual distributor can simplify the investment process. Example, I have an MFD, I have a distributor, and handle all necessary paperwork transactions as a navigation-based action. This can be saved investors such a time and effort. Sometimes understand, I might be very savvy, okay, but in other things, but I not be very savvy in my financial services. I might not be knowing way to invest. There where I need a guide, I need somebody where I can go through. That's the role of an advisor. Okay. Many MFDs take a personalized approach by tailoring investment recommendations based on investor-specific goals and risk tolerance. Risk-based investment, goal-based investment. Most MFDs possess in-depth knowledge. Most, I say not everyone, most. Be it about mutual fund products, related financial instruments, or even the broader financial markets. Understand, there are 47 mutual funds. There are 4,000 plus schemes. Sometimes become difficult for a normal person to go direct. Which one to do, which one is right, which one is bad. Hey, the distributor, his day in, day out job is that. So he becomes that bridge in between. Investors can proceed with a confident assurance considering MFDs would operate in a strict regulatory environment. Understand? They come under the ambit of AMFI, Agni under the ambit of SEBI. They have to be qualified enough, which I'll come in the end. Direct plans, which is gaining a lot of traction nowadays. Mutual fund are procured direct either online or physically by visiting registrars or mutual fund company's office, or there are nowadays many sites which offer direct plans. You invest so that they offer direct plans. You can invest direct to those things. There is no involvement of third party eliminating any commission or distribution fee. That means expense ratio is less. That difference is basically flowed back into the NAV, so higher. In making investment decision independently means investors conduct own market research. You are doing yourself. Either for investors who are well versed in investment matters and don't require professional help. Direct plans contain direct or direct. It's written very clearly, right? Regular. Direct mutual fund plans were introduced by SEBI in January 2013, as we mentioned before. It made mandatory for all mutual fund houses to launch direct plans for all schemes. Advantages: lower expense ratio means a smaller portion of investment goes towards fees, allowing more money to be invested in the market. Very simple. Okay. Direct plan often provide higher return than often. Directly engaging with the fund house mitigates the risk of being influenced or misled by third party. These are advantages. Ideal. See, understand this is just for illustration purpose. The slide in front of you, I'm going to speak out on this. Doesn't mean that these returns will be there in the future. The difference will be in the future. Direct was ideal in theory, but not always feasible. The following example: monthly SIP amount 25,000 rupees in a direct plan and 20 in a regular plan for 30 years. 12% return in both. Expense ratio 2%, 1%. We are mitigating commission 5.17 or 6.46 crore. That's the difference can be. As the number of years pass by, the difference become even higher. In between regular type will give you more return because expense is lower. That's building the NAV. So longer the period, the better it is. But remember one thing here. I'll be very, very careful. But do we know where to invest? In direct, I think I'm savvy enough to know where to invest. Sometimes people make a mistake by taking individual decisions. If you're savvy enough, you know what you're doing, you have a control over your emotions, you have a control over your investment, you're very strict on your own goal-based, very good. Otherwise, going to regular, going to right intermediary can be a better option. The trends. The trends have been very, very different. You know, like this is the data of 2022, but I will give you the later data because I could not retrieve. So I'll speak to the latest also. It's generally seen corporates, you know, which used to form a sizable investment in the mutual industry, 60, 70, now it's down because retail investments are huge. You know, SIPs around 27, 25, 26,000 crores every month. Corporate banks and FIIs prefer direct route because they are bulk investors. For them, that little saving in NAV or the expense ratio with a high NAV, boils down to a huge return difference going forward because they're investing in crores and crores. But while most retail and HNIs who need a hand-holding still rely upon distributors. Very clear. HNIs, 75% black is basically your direct, regular. If you very clearly FIIs, bank, corporates rely more on direct, whereas the retail people or HNI rely upon regular plan because they need a distributor, they need an intermediary to handhold them. Very clearly mentioned. Growth in AUM. Presently, around 35%, 25%, 25% is what is there is the direct is rising. But direct is rising in assets more towards corporates, more towards banks, more towards FIs and HNI. Retail still prefers going to the intermediary. At the scheme bifurcation, I'll put the later data also. Equity, 70-80% people still prefer going through a distributor. FIs, very little, bank, very little, retail, 85. Presently also 70-80% people prefer. In debt, retail, 75%. So that's the bifurcation. Like today's markets crashed because of various geopolitical reasons, market reasons, China reason, domestic reason, etc. The fact is, but a panic. Now, if I'm a direct investor, I might panic. I might, oh, what will happen tomorrow? As a distributor, my role will become to handhold the person. That's what the commission is going to be. So if I just given a bifurcation of equity, debt, balance, gold, it's very, very clear with equity, debt, and balance fund, most of the retail and HNI rely upon regular plans, whereas in gold schemes, it can be a gold ETF, it can be a gold scheme, mostly people go direct. It's a SEBI consultation paper, which came out. It's a very latest, still under consultation. I just read it out for you for people who want to know. SEBI September 24 of recent release considered paper on draft circular for disclosure expenses, half-yearly return, yield, and risk-o-meter scheme of mutual fund. Public comments on these proposals. Current scenario: the regulation requires half-yearly disclosure of annual financial results. Proposal: since direct plans have different expense ratios, understand, and returns, SEBI's propose as such disclosures pertain to both direct plan and regular plan shall be disclosed in a standard format. This is very, very crucial to understand. People who want to understand the legal side of it. Global champions. What are the global champions presently? Vanguard, one of the leading mutual funds of the world, founded in 1975 by John Vanguard, introduced the first index mutual fund, pioneered the concept of no commission direct investment. More than half of Vanguard USD 8 trillion assets are in direct plans or no load funds. Fidelity, one of the largest asset managers in the US, followed by Vanguard lead by introducing no load mutual fund and low cost index fund. Further disrupted the market by offering zero fee funds in 2018, drawing massive inflows. Hargreaves Lansdowne, leading platform for investor access direct mutual fund in the United Kingdom. In India also there are many. The company offers a wide range of no-load funds via these platforms, which help grow direct mutual fund. BlackRock Global, BlackRock in India also, world largest asset manager, strong advocate of direct funds, launched iShares ETFs. Today's iShares comments in assets under management. Remember one thing, India comparatively, if I rule out UTI 64, which came in 1964, India is relatively new in the mutual industry, 64 lakh crores, with only 4.5 crores individual folios or 5 crore individual folios presently in India. Where the US or the UK advanced market, where 70, 80%, 90% people invest through the mutual fund route. In India, hardly a percentage invests for mutual fund route. So we basically are more inclined for somebody holding our hand. Okay. So this has shown internationally how a system moved to direct, but they have moved off recently. In India, we're still far behind in terms of direct, where you require intermediary to help us because the plethora of mutual fund, I said 47 mutual fund and 3-4 more in the line with 4,000 plus schemes. It's very confusing. So that's why people rely upon distributors more. That's the reason. Understand one thing. When I say a regular plan means you are necessarily taking the route of an intermediary, route of an advisor. But I put a slide here to show that how to choose, people who are investors here who are listening, how to choose the right advisor also. That also becomes very, very crucial, very, very important. Mutual distributor must have passed the NISM 5-year certification test. There cannot be somebody just walking on the road and starts advising you, please invest here. Please invest. I know it. No, this I know thing doesn't work here. It has to be, there's an exam, it's the NSM. They get certification test as meant by SEBI. Successful company NSM mutual fund leads to AMFI ARN number. So they need to have an ARN number. Then only you can invest for distributor. Check the mutual distributor qualification experience. Very, very crucial. Consider MFDs who are reputed enough in their field. They can be new also. Somebody new also, why not? Have a proven track, not necessarily somebody who knows, somebody who works for you, for the investor. He's the person for you. Must have a track record, maintain an equal level of transparency. He should be good enough, he or she, telling you where the investment is happening and who's guiding you in a goal-based manner. And MFD shall provide you the comprehensive investment platform. This may consist of an online desk that allows you to review your current holding, portfolio value, dive into customer reviews and testing. Very, very crucial. See, before I proceed further, it's not a very long presentation. The basic difference is in the commission and the expense ratio. I'll repeat, if you are savvy enough to understand the markets, savvy enough to understand your goals, have a control over your emotion, have a control over the markets, go for the direct. But if you feel you are not savvy enough, you are busy enough, you need a hand holding, then go for a regular plan with advisor. For one mistake in a direct plan can have a long-term ramification. But a good advisor can help you beat the market, can help you achieve your goals also. That's a regular. So that's a price you pay for that. That expense, basically the expense ratio, nothing else. As I said, it's a very small presentation. NSM people offers, a lot of what do you call courses, like on mutual fund certification, the NSM 5A series, it's a 2-hour paper, you can write that. Okay, people who are interested in learning more, they can write this exam, become MDs also. This is a basic rule. 5B foundation certification, the charges are mentioned. The examiners seek to create a common minimum knowledge benchmark for all persons involved in selling and distribution of mutual funds. E-learning course, mutual fund basics. This course will help you to understand the basics and start your journey to know how to invest in mutual fund. People who want to learn, they can have this e-learning course, a fantastic course content, introduction to mutual fund, concept of NAV and tier, type of mutual fund, how to invest in a mutual fund. You can go through that. Basic is mentioned here. It's a 4-hour instructor-led pre-recorded sessions. Course access for 30 days from the day registration, 100% online, self-paced e-learning course, a certificate upon successful completion, course fees paid 100. The fantastic courses by NSM, so have a look at it. So I will say, I said, I want to keep this session more on answering the questions between direct and regular, but both are here to stay. Direct definitely is growing, but regular is also growing with the market participants coming in. I'll open the house for question and answer. I said this was a short presentation. So any questions, I'll be more than happy to take up maximum number of questions this time frame. Amir.
Yes, sir.
Yeah. It's a short presentation because nothing much on this, so I can take a question answer. That'll be more important here.
Yes, sir. There is many. Actually, the basics doubts are clear. Now the audience will come up with the questions which they have.
Sure. Yeah. Please.
So how to answer by MFD when investor is doing direct investment?
How
when,
to?
how to answer by MFD when investor is doing direct investment?
How to? I didn't get you. How to? Can you just repeat a little louder?
Just a sec. So Mr. Vijay Shri Karwa has asked, as AUM increases, the turf falls. As AUM increases, trail commission increases is not contradictory. Whether two statements are contradictory or not.
No, sir. I tell you, what happens is as the AUM increases, your expense ratio comes down. Your expense ratio, there's a proper structure given by SEBI that not necessarily your trade commission will start coming down, going up. Your basically everything has a ceiling. Your expense ratio, Karva sub, starts coming down. Okay. As the AUM increases, the expense ratio starts coming down. When your assets are low, you can offer a higher expense ratio leading to maybe a higher commission on the trade side. But as your AUM rises, okay, mark to market or whatever it is, your expense ratio falls, leading to the other. So please, it's not about the trade commission, it's about the expense ratio. Expense ratio falls as your AUM rises.
Okay. Mr. Sachin has asked, why index funds have low expense ratios? Is it because of passive funds?
Yes, absolutely, because of passive funds. See, understand one thing, why the lower expense ratio? The role of a fund manager is minuscule in the case of an index fund. But basically, it's a mirror image of any fund, right? It's a mirror image, okay? So there's no stock picking is happening, right? So it's basically mirroring the particular index, whether it's Nifty 50, whatever it is. So the expense ratio is automatically minuscule. There's no role. That's the reason the expense ratio is very low in the case of index funds.
Okay. Vijay Shri Karwa again has asked, from which pool higher commissions are paid?
Which?
Pool.
No. That's basically the expenses which you are charging. That's the commission is paid. The commission is also Karva. There's nothing like a pool. It's basically when you invest your money, it's from the your fund only where the commission is coming from. Okay, where the assets are building up, the commission comes from there only. There's nothing separate pool like that. Okay, nothing like a pool like that. Please. Okay, Karva,
Okay.
there's nothing like a pool.
So Amit Joshi has asked, there was a news of evaluation of brokers by SEBI has blown in the market. Whether it is true.
Can you just be a little louder? There's a lot of noise here. Sorry, Amir. Yeah.
Sure, not issue, not issue. The news of evaluation of brokers by SEBI has been blown in the market. So whether it is true or
Very good
false.
question. There's no elimination of brokers. There's elimination of brokers who missell, who are not qualified enough. They have been so-called been asked to eliminate. Example, as I said in the end, suppose you have to be a mutual fund distributor, you need to pass this NSM 5A, etc. examination or the certificate, which are compulsory. There were many distributors who were just selling or promoting mutual fund without having any background, without having a particular certification. They have to weed it out. Otherwise, there's just a rumor. There's nothing. Brokers are not being eliminated, not at all. If you're qualified, in fact, SEBI is welcoming more distributors in the industry. We are undersupplied. We need more supply of distributors.
Okay. So one of the attendees has asked, in regular funds, is it difficult for a nominee to get transmission?
Nominee?
Yeah.
No. See, understand, there's no difference. Regular plan and direct plan, when you are investing directly. If you want a nominee, something happen, you go to the AMC, they will do it for you, or you just sign a form or do it online. Secondly, in a regular, everything remains the same. It's just an intermediary in between who can facilitate. Rest, everything you have to do. If the distributor or the example, he facilitates whether investing directly, whether investing the right manner, which scheme to choose, etc. But advantages, he can help you. He can make it easier for you. The rest of the process remains the same. There's no difference, please. Okay. Difference only in terms of there's an intermediary in between who's helping you, who's guiding you. There's no other difference.
Okay. Mr. Samir Savai has asked, as you are showing the comparison slide on direct and regular, with the final comparison of label of direct and regular inverse, question mark. As a calculation suggests, whether it was inverse kind of thing?
No. See, I'll tell you. That's why this slide which was there, which I showed, it showed a difference of 30 years of investing in equity scheme of maybe 25,000 rupees a month and as an SIP, just an exaggerated example, that a difference after 30 years can be 1.2 crores. See, understand one thing, the longer the period, okay, because in regular, the commission angle is there, so that will basically cut your NAV, so your returns will be impacted. That's the only difference. That's what I showed. It's in front of you right now also, the slide. Okay. That's around 20% more than the regular plan. There's nothing inverse, etc. There's nothing like that. Okay. This is just an illustration purposes, but yes, over the period of time, their regular will have this different. It can be 1.2 crores, or it can be 20 lakh, 30 lakh. That depends on number of years you've invested. Nothing like inversely proportional, etc. Nothing like that, Amir. Nothing like that.
Sure. Radha Khan has asked, so can you just elaborate the process for direct purchase, direct fund purchase?
See, in direct purchase, there are two ways to do it. There are, I cannot name because regulator doesn't allow me. There are various sites. Which you can go, you can Google, various sites who offer you direct, there are various direct platforms, okay? And or you can go through the mutual fund, also open up a mutual fund site, any mutual fund example, ABCD, their site. You have to fill up the mandatory field. If your KYC is not being done, whether you're doing to direct mutual fund or going through a platform, advantage of the platform is you have access to all the mutual funds. Otherwise, you have to go individual to every mutual fund house. Do your KYC. One KYC is enough for every mutual fund. Once you've done that, then you select a particular scheme that we mention very clearly in that platform. You are investing directly. Okay, so there's no regulatory written direct. When you invest through a mutual fund, also through a mutual fund site, that is automatically direct. That's the basic way. Choose a platform or choose a mutual fund go there, do your KYC, and then it's written on their direct plan. That's the basic way. There's no difference otherwise.
Noted, sir. So, Mr. Vivek Shah seeking some guidance from you. When there are certain platforms or misleading for direct plans as a commission to MFD, how to handle that?
How? Sorry, can you just repeat it, please?
Yeah, when some platform mis-selling direct plans as a commission to MFD, how to handle?
The direct plan will not be mis-selling. See, direct plan, understand one thing. Once you're going directly, okay, to a platform, okay, obviously, I don't think so there's MFD involved in that. Amir, am I right there? Okay, if I heard the
Yes,
question
sir.
right.
Yes, sir.
Right. When you're investing direct, it's very clearly mentioned direct. Okay. So there's no scope of mis-selling. You are choosing the scheme. When you're going direct, you are responsible. You are choosing the scheme. Okay. So entire liability comes on the investor. But if the MFD investing to a mutual fund distributor, okay, and he missells you and you are dissatisfied, you can complain to the mutual fund concerned, or you can complain to the AMFI, Association of Mutual Funds in India. There's one person asked to the AMFI, I'm reading that, which is the Association of Mutual Fund. It's a body, it's no to profit body out there who gives you the ARN number to the MFD. You can complain there also. They will ask for a justification from the MFD. Then why did you missell it? One is that he justifies is fine. If he doesn't justify, his ARN number can also be cancelled. But if you're doing a platform which is direct, the entire responsibility is yours because there's no MFD involved out there. Amir, is it okay?
Yes, sir.
Yeah.
Mr. Praveen has asked how to handle customers who are inclined towards direct investment but spend a lot of their time with us and get free advice.
Yeah,
As a mutual fund
fantastic question.
distributor,
Yeah.
and a mutual fund distributor, whether he is allowed to charge a random consultation fee, if yes, does it come under regulation?
Yeah. I'll answer in two parts. Understand, like I answer in a very simple, which has become a very, everyone answers that way. I took an example of an entrance exam, you engineering or MBA, any other course. One is that you study yourself and you're good enough, you write the exam and you may take admission to the engineering or the MBA colleges. One is that you go through a professional course, which basically, other than your 12th or graduation engineering, guides you through the competitive examination, right? And you become equipped to, know that this type of question will come in my competitive exam other than my basic CBSE or ICSE, etc. So basically, you pay that person and you write the exam, the chances of success become higher. It's like going to a doctor. If I have a simple headache, how I used to explain, now I'm not a distributor. When I used to tell, if I have a headache, I take a Seridon. If my headache persists, then what I do, I go to a doctor. I don't go to a doctor and tell him I have a headache, please give me this medicine. He tells me the headache person, you go to get your MRI, etc. done. Then he takes a test. Then he advises me, okay, Sanjeev, you have to take these medicine this time, this time, this time. He also asks me, are you basically allergic to any medicine? Do you have an acidity problem? Okay, then I will not recommend you this. I will recommend you this. So you have to basically ask the client, or when you're going through this kind of a situation, tell the client as a distributor what is it. You have to handhold. This is how you see. I always say, even example, even Arjun needed Krishna during the Mahabharata. So you have to tell that. So maybe you need an advisor. Secondly, can you charge a fee? There the question comes of RIA, Registered Investment Advisor, RIA. Understand, if you are charging a fee from the investor, then you cannot take the commission. Then you cannot take the commission. You can only do one of the things. Either take a commission from the mutual fund, okay, then you're an MFD, or become an RIA. We are not charging a commission, but you're charging a fee for managing the asset, upfront fee or the management fee from the investor. You cannot do both. If you want to do both, then you have to have a separate organization for that. So that's the basic. There's a regulation. SEBI is very, very strict on that. If you don't want to take a commission, you want to charge a fee, you have to become an RIA, Registered Investment Advisor. For you to pass another exam, 10A and 10B. If you don't want to do that, you want to win MFD, then the commission is there. Amir, I hope I've answered this thing.
Yes, sir. So one of the attendees asked, which mutual fund schemes are good when market is volatile, when geopolitical situations are not good?
Very difficult question to answer. Okay. I'll tell you, Amir. Sorry.
Yeah.
Anybody who's asked this question? What's the name of the person?
That was anonymous.
Okay. Okay. I'll tell you one thing very, very clearly. See, understand when the markets are volatile, it depends on your goal. Suppose I have a goal for 10 years. Okay. I have a goal for 10 years. Like example, buying a house or, whatever it is, buying a house, or going abroad, or maybe daughter's wedding, son's wedding, whatever it is, ABC. And I'm investing in equity. This volatility of 1 month, 2 month, 3 month geopolitical situation, whether it's the Gulf War, whether it's the Russia, Ukraine, whether domestic problem is there, should not impact. It evens out. It evens out. Okay. Even COVID, in the height of COVID, the market crashed on 22nd of March 2020. Everybody thought that everything is over, but markets recovered in 6 months. And what a rocket rise it was, from 7,600 to 18,000 in 6 months. Understand, if you have a long-term goal, these things should not impact. If you have a 5 to 10 year horizon, 10 year plus horizon, my view, this is my independent view. NISM got nothing to do with that. Please, you can invest in large cap equity. Go for that. Don't get perturbed by these small term what is happening. This will die out automatically. So don't have to bother. If you long term, 5, 10 year plus remain in equity, do your SIPs, take advantage of averaging, the law of average, things will be taken care of automatically. Don't panic. That's my advice to you.
Right. So Ms. Ashwini has asked, can we do folio transmission online?
Folio?
Transmission.
Yeah, you can do online. I think so. You can do online. I'm not very clear on this. I think so. If the SEBI is allowed that now. Yes, you can. But
right.
I have a little. I'm 90% sure. 10% I have my doubt. Very honestly, sir. Okay.
Right.
Yes, you can do. You can do now. Yes, I did. You can do. Yes, you can do.
So, Mr. Prakash has asked how regular outperform direct in long run as per the example as expense is low in direct.
Sorry, can you repeat the question?
Yeah. I think you should reframe it. How regular outperform direct in long run as per the example as expense is low in direct.
Mathematically, understand one thing. Suppose you invested 10 rupees in one large cap scheme today, and in direct and regular both. Okay. Both have a different expense ratio. After 10 years, in a regular plan, this might become 100, and you're in a direct plan, this might become 120. Always a direct plan from time to time, second to second, from the same scheme will not outperform, will give you a higher return than the regular plan, always mathematically, because the investment done by the fund manager is the same. Because the expense is lower in a direct plan, the return of the direct plan for the same scheme, for the same time frame, will always be slightly higher. How much higher? That will depend. So regular plan will never outperform a direct plan in the same time horizon. Direct plan will always outperform the regular in the same time horizon for the same scheme. Please remember that mathematically.
Sure. Okay. Now, Mr. Kamlesh has asked, sir, is a distributor commission stand to 1% or will it vary based on the fund house or AMC?
See, it is basically depends on it's a SEBI thing. It can increase or decrease. It also depends on the AMC, but it also depends on regulator. What's the ceiling? Basically depends on the AMC and the regulator and the scheme you are investing in. That's the basically trail commission depends upon. It can be higher also for a few AMCs if it's under the limit of the expense ratio. If you're not busting that, they can pay you higher.
Sure. Sir, on the request of many candidates, and we have received a request, we have shown the comparison of last slide. Can you just once again
regular or direct wala?
Yeah.
वही है सामने एक second.
Yeah, you can just
यही वाला ना जो सामने है?
Explain it once. Yes, sir. The comparison.
I'll explain it again. Okay.
Yeah.
I'll repeat it. Understand, this is just an illustration. It might not always be good, but direct will always outperform regular. But you cannot take away the efforts of the distributor in between. That's the difference. Now, suppose you invested 25,000 rupees. It can be 1,000. We just taken 25,000 as an example, please. Monthly SIP amount is 25,000 in a direct plan and a regular. Assumption is annualized return is 12%. It's an assumption. Okay. Investment tenure is 30 years. That means you did not remove the money. You continuously kept investing, Expense ratio for a direct plan is 2%. Oh, 1 second. There's a difference here. I got the mistake. What person asked? 1% is direct plan and regular plan is 2%. I'm so sorry. There's a mistake, Amir, in my slide. Okay.
Nevertheless, we can explain now.
Yeah. Okay. Direct is 1%, regular is 2%. I'm so sorry. That's the difference. So the final corpus at the end, please, is 1% for direct and 2% regular is written wrong here. Final corpus at the end of the SIP tenure is 5.17 crores for direct plan, 6.46 for direct plan and 5.17 for the regular plan. I've interchanged. I'm so sorry. It's a mistake here. Okay. So the first column should be regular. Second column should be direct. It's a mistake in my side. So 1.29 crores more you'll get in a direct plan over a period of 30 years. Clear? So that's basically because the expense ratio is lower. That's the reason. Amir, clear?
Yes, sir.
Yeah. I'm so sorry, Amir. I'll forward you again. So you want to share with the, I'll interchange direct and regular. That's a mistake from my side. Yeah.
No,
that's
sir.
why another person had asked me some time back. I did not gather this mistake here. Yeah. So please, guys, who are seeing this slide, the first column is regular, second or direct. I've written it wrong. I've written it should be interchanged. Yeah, Amir, any other question, please?
Mr. Vishal has asked, the bank demand charge more or online platform charge more for that?
Pardon?
The bank demand account charge more or the online platform charge more in case anyone will do
Online
investment?
platform, basically you are paying the conveyance fee, nothing else. Demat charge is totally different with the bank is charging. Yeah? You basically pay for the conveyance fee when you do it online, that 30 rupees, 20 rupees, whatever it is, which you, whenever you do, when you buy also, when you do some banking transaction also, when you do IMPS also, you have to pay 6 rupees now or 5 rupees or 4 rupees. So understand, this is that charge, nothing else is charge. No. So there's no comparison here, Amir. Okay.
Okay. Mr. Prabhakar has asked why B30 trial commission has removed from MFDs when they are playing an important role for the beginners who want to invest.
Amir, I really cannot answer this question. This is upon the regulator, but I think
Okay.
so. They are debating that and coming back to some, back to the old days. I think so. I'm not clear, but this is, I leave it to the regulator to answer. I have no right to answer this question here, honestly. Why they bring it? Yeah.
Okay. So Mr. Sitij has asked, is there any procedure to switch from regular to direct plan?
Not really. But what I see, you have to start afresh. There's nothing like, otherwise what happens is you have to take a no objection certificate from the distributor. Okay, that I'm shifting direct. There is no procedure as such aligned for that as of now. Okay, there is a long-term procedure that you have to stop from the distributor, start afresh from a direct, or take an NOC from the distribution. I don't want to continue and then redeem and then start again. That's the procedure. Take an NOC from the distributor first.
Okay. Ms. Samiksha has asked how the investing in mutual fund schemes and mutual fund ETF is different at the time of redemption.
Pardon, can you just repeat?
How the investing in mutual fund scheme and mutual fund ETF is different at the time of redemption.
I'll tell you. See, first of all, understand one thing, the basic difference. ETFs, exchange traded fund, you need a demat account. ETF, you're buying and selling from your demat, from your broking account. ETF, you can redeem anytime between 9:15 to 3:30 when the markets are open. Okay, so you will get the NAV of the time you exited. So like if you buy a share of ABCD company, example, you bought at 10 o'clock, you sold at 12 o'clock, you bought at 90, sold at 100. Okay, suppose you sold at maybe at 3 o'clock, the price will become 80, you'll get 80 rupees, right? But when you invest in a mutual fund, which is not an ETF, you first of all, you don't necessarily need a demat account when investing in a mutual fund scheme. ETFs you need. For when a mutual fund scheme, you'll get the NAV of the one NAV. You can't trade one NAV of that particular day, whether you redeem at 9:30 in the morning or 2:30 or 3 o'clock. As the time permits, you'll get that relevant NAV of that day. But in the case of ETF, you will get the time-based NAV when you redeem, whether it's 10 o'clock, 10:30, it can differ. That's where, and you need a demat account because you're buying and selling from your demat, buying and selling from your broking account online. In the case of NAV, in case of pure mutual fund scheme, you're buying and selling on a pure NAV base and declared once a day, whether redemption or whether it's a purchase. Amir, I hope I've answered this.
Yes, sir. So,
and I made the correction also regular and direct on my slide, which people can see.
Yeah. Sir, Mr. Upesh Seth has asked, if the expense ratio is lower, that is below than 1% in direct plans, it is good for long-term investment?
Yes. The longer the investment, see, understand simple, the longer, because ultimately the expense ratio forms a part of a NAV. NAV is a barometer for your returns. NAV went from 10 to 15, you made a return. Okay. So obviously, because the expense is lower, so NAV is higher, so you get a better, and as the time flies, it will keep building on. So your returns will be higher, as very clear in this particular slide which is open for me. Yes, it will. Yes.
Okay. Sir, Nidhi wants to understand that if 1 year return as per the data and benchmark are better than 3 years and 5 years, then why it is said that we should invest in mutual fund for longer period, 5 to 10 years?
I'll tell you. I'll ask you a very simple question. Suppose we are sitting in 2000, September of 2019. Okay. Your NAV, you have invested your money at a very good, you're getting a return of 12%, 10%. Just a hypothetical example. Come March of 2020, I don't want to go to those period, but I'll take that example. When the COVID hit, your entire, your returns vanished. Your returns vanished. Okay. In equity, didn't they? The return vanished. It became negative. Okay. Because they invested only for 6 months thinking the 1 year return will be good. 1 year return can be extremely volatile in equity. Today, the markets crashed. Various tomorrow might rise, day after might fall. We do not know. That's what said. You never invest for 1 year in equity. Always look at a 3 to 5 to 7 year horizon. 1 year can be deceiving. If understand, I have a very simple formula here. This pure financial planning formula. Suppose you are investing for a particular goal of 5 years. You say, Sanjeev, I have invested 100 rupees. I'm looking at a return of 10%. So after 5 years, I should make 110 rupees. If the markets do well and your scheme does well, and you're able to generate 110 rupees in 1 year, remove the money and put in a safer asset, which is not equity, put in debt or some liquid scheme, etc., or mutual or any other FD. The fact is, it is goal-based plan. That's why we said equity for 5 year plus, other scheme for other various horizons. Very, very, that's why they always say equity for longer term, because in 1 year it can be deceiving also.
Right. Sir, Miss Nidhi has asked if she wants to transfer the scheme from regular to direct.
Yeah.
Then what will the start date of the scheme will be considered? The original start date or the policy transfer?
No. Where this is because you take the NOC, you reinvest to start date. See, you have made a money. You made an ABC. It will not be from day. So there'll be a break in between. When you redeem, when your assets are transferred to direct from that day onwards. So you might lose on those couple of days in between.
Right. Miss Samiksha.
That's any scheme. Whether you switch also, that thing happens.
Sir, Miss Muskan wants to highlight because she wants to get your opinion regarding value and contra funds. What are value and contra funds? How they are different from diversified funds?
Okay. First of all, okay, this we're going to a different direction, but I don't mind answering. Okay. See, diversified funds are, first of all, irrespective of the market capitalization. That means irrespective whether the company is small, big, or large. Diversified means that you are picking up schemes. It can be from various sectors. Diversified. It can be from pharma, it can be IT, it can be banking, real estate, mining, etc. You're diversifying your portfolio. That's a diversified fund, right? Secondly, value is because I see value in this. When I value pick is that, okay, the markets might not be doing well. The industry might not be doing well. The pharma industry might not be doing well. But I find this ABC stock in that pharma has some potential. It is doing something which will add value. So I pick up that. That's a value fund. Okay, that's up to you. Invest in those particular stocks which the fund manager has value to grow in the future, irrespective of the market condition. Contra. Contra means when I take a position which is opposite to everyone, which is opposite there. By somebody, everything is doing well. Real estate is doing well, banking is doing well. I will take a contra position. That's why I will invest in a what do you call in pharma, because I feel pharma and maybe some other mining will do well. So I take contra bets. That is opposite to the herd, opposite to the what is happening in the all across the country, all across. I take a contra bet. That's a contra fund. Basically, you can invest either in contra value because both are not allowed. So that's the reason. So, you can invest anywhere, but scheme preference. The contra is when you take a position which is opposite to the popular beliefs. Values when you see value in a particular stock, irrespective of the markets. Amir, I hope I've answered.
Yes, sir. So Mr. Amitesh has asked whether you feel the direct plan should also disclose the tax impact of switching to the prospective switch
Yeah, they
investor.
should. It will be. It will be. Yeah, and they should be. Yes.
Right.
Yeah.
Then the conjunction with that, Upesh Seth has asked, so when should LTCG is charged? If
See, it is
only,
charged from the date of investment.
okay,
From data, because ultimately same scheme, the date of investment. You're not redeeming the money. You're not
right,
redeeming. But if you're switching, then it's a different ballgame altogether. Remember.
right.
Okay.
So we can have more two questions.
Yeah,
Two,
you
three.
can. Yeah.
Okay, Samiksha has asked. Yeah. What is the rule suggests when investor transfers AUM from one MFD to another MFD? When the latter MFD will get commission for the AUM of the AM shifted?
No. The past one, as per the regulation, which I know, I might be slightly wrong here. There's a disclosure that the past, suppose you shifted from one MFD to the other MFD, and the past the commission of the MFD, okay, does not go to the new MFD. No, he will not get it. No.
Okay. So Mr. Nishant has
But
asked,
there's a caveat here. There are a lot of disclosures here, but as a plain, simple vanilla, he doesn't. He or she doesn't.
right. So Mr. Nishant has asked, many times in the market, we heard the name of only MFD, mutual fund distribution comparatively, in comparison with RIAs. So why is it that
Sorry,
so?
can you repeat it? I'm so sorry. I can just repeat.
Yeah. Mr. Nishant has asked, majorly we are hearing the name of MFDs only, mutual fund
Yeah.
distribution, in comparison with RIAs. So why is that so? RIA is not
I'll tell
popular.
you, this is a very good question and very closer to my heart also. Fact is, see, understand, we are still in a very nascent stage of mutual fund development. See, India is a very emotional country. It's very regional specific, very country specific. I take a very funny example, so don't misunderstand. We are more bothered about, buying coriander free, getting coriander free with buying some vegetable other than the other thing. Halaki, we don't pay that 10 rupees, that way give me 10 rupees coriander, dhania de do. It is that way. The fact is, some of the other, we are still not attuned to why should somebody charge me a fee, RA charge a fee, which is basically very prevalent in the Western world. Ultimately, you don't mind paying a fee to a lawyer. You don't mind paying a fee, whatever it is, to a doctor, or anybody, a profession. But distribution of financial services, we have a problem paying a fee, which should not be the case. It's basically building up, but the new generation is catching up. So RA, I will feel, will grow over a period of time. Okay, it's an emotional kind of a blockage. It's a kind of that kind of historical blockage because we fear why my money will go. We don't pay that. Halaki, he's giving you all the services he or she is giving as an RIA. He's charging a fee and not taking a commission. And you are investing mostly in a direct plan. So understand you're benefiting on the return also. So it's basically more to do with emotion, but over a period of time, it will catch up. This RIA thing has been on for the last 14, 15 years. Still not caught up because you keep hearing about MFDs. There are many RIs who switch to MFD, but now there's a slight change. Many MFDs are knocking the doors of RIA also with the advent of direct plans.
Right. So Mr. Rahul has asked whether there will be any taxation impact when you are switching from regular to direct plans.
Not really, not really, not really. No, no, no. It's the same scheme, same scheme. See,
Okay.
equity as such 1 year plus, yeah, it is that. But my advice to everyone will be not that today we had a presentation on direct and regular. Okay, and you simply decide let's shift from regular because return difference is there. See, understand the role of if you are with a good distributor, he or she is advising you, he or she is guiding you. What I'm telling you, they are telling you to remain, markets will fall. Don't worry, market will rise. He or she is hand holding you. So don't take a jump. Oh, I will shift from regular to direct because there's a return difference. That's not the way to choose. Not really. And that's a difference. It's not the way to choose in the right manner. Just put a remark out there.
Right. So just a layman or basic question Somnath has asked to start with. How do he will analyze a good mutual fund?
Pardon?
How do we whether he wants to
How to analyze
invest
a
in
mutual
mutual?
fund? See, I'll
Yeah.
tell you. If first of all, answer this to me. If you're from the industry, if you're interested, analyze a mutual fund. Otherwise, leave it to the MFD to do that. That's his or her role based. That's why he takes or she takes a commission or RAA takes a fee. The fact is, otherwise, there are many sites. There are many sites available. Simply put, you'll get all the returns, all the comparisons of all the 4,000 schemes available in different asset classes. I don't want to name it because I'm not allowed to name. There are various sites in them which are very common. DAOs. You can simply plug in what you need, your goal base, you'll get a comparison. Start from there. But if you're a beginner, go to a distributor. He or she already has this comparison. If you want to do it, the mutual fund also has it, and there are various sites available in the market today. You just have to Google it. You'll get various. It will show you the comparison of various schemes of various mutual funds. There's no rocket science in that.
Right. So a take-based question. Shubhendu has asked, how do ARN holder convince direct investor? Because right now the AI tools are there.
How to?
How do a ARN holder convince direct investor? Because many ARN tools are there in the market so that they can approach. So थोड़ा सा job security
मैं
वाला
थोड़ा सा
question.
कंफ्यूज हो गया मतलब मैं जरा Amit, because there's some disturbance outside. Can you repeat? I want to answer this question. Can you repeat it again if you don't mind, please?
Yeah. The person has asked, how do we like ARN holder convince a direct investor
Yeah.
when AI tools are also there in market?
देखो यार देखो AI ultimately AI is a facilitator. Okay. AI is a facilitator. Okay. Zoom is a facilitator based on AI. Am I right?
Right.
That I'm able to address 300, 400 people in one go. Okay. Ultimately, you are listening to me. AI cannot replace an human human intellect. It can add on human intellect. Understand? It cannot give you emotions. Okay. See, understand when you go to I told you one very beginning example, and anybody can convince that way. Okay. Because I speak to a lot of MFDs also. The fact is, I'll repeat it again, which has started my discussion with that. I was at a historical place, okay, at a monument. There were three ways. One is somebody walked in, Are, sir, please come with me. I will show you when this temple was built or when this fort was built. I know everything. One is a person came with a band on his, he said, I'm qualified, and I checked up, his name was there. I go through him. That is our MFD. I go through him. He charges a fee, which I pay to him. I pay to the monument guy because I'm going through the advantage. I pay a fee and he tells me slowly what was this made, when was this made, when this came up, etc. I'm thinking. Second is, I get earphones. I get earphone, that is AI. So I go to the I go to the what do you call fort. I stop at every pillar. If something comes, now you're on pillar number 20. This was built here. That's AI. But again, I might skip something relevant. Oh, I'm getting bored. That different. So somehow you have to convince that way. Boss, you require human touch. You require what is important for you, because in AI, you'll not be able to human what my likes and dislikes will not be there. That's in the case of the MFD. That's in the case. That's how you convince a direct customer to come to the under the ambit of an MFD, under the ambit of a distributor. Remember this thing. Clear? Very
Yes.
difficult to answer, but I've answered diplomatic. It is that way.
Yeah. So,
Yes.
so Rohila has asked, the expenses percentage will be fixed or fluctuate?
It can fluctuate, yeah. It can. The expenses, na? Yeah, it
Expenses.
can fluctuate on the AUM. It fluctuates, yeah.
Right.
It fluctuates on the expenses. They can fluctuate.
Okay.
That's why
Okay.
TR. That's why TR has to declare on a daily basis. Though you and me get a fact sheet on a monthly basis, but TR is declared on a daily basis for every scheme.
Right. Then Mr. Shekhar Raj has asked, mutual funds AMG is allowed to take position in FNO, future and option, for age while market crash.
Yeah. This hedging is hedging basically on a very conditional thing. They can take a call on that. Very conditional, but not very small percentage. They use the tool for hedging purposes. Yes, they can.
Okay.
Not every
Uh,
scheme. It has to be listed in which particular scheme they're doing it. Not in every scheme. Please remember that.
right. Once again, Rohila has asked, in mutual fund, any ELM, extreme loss margin percentage
No,
consists?
no, no, no. Not enough. Mutual fund is not done.
Okay.
Not you
Pooja has
can't do it.
asked,
Yeah.
okay. Pooja has asked whether she can start SIP with 5,000 and price are goes down, then can how adjust to regular plan if the inflation is there in market?
No, I didn't get her. What is she asking?
Uh, she has started the investment in SIP with 5,000.
Okay.
Whether and price are going down, when then how to adjust a regular plan when the inflation are there in market?
Very simple. If you're doing an SIP, I'm assuming she is doing for a longer term, right, Amit?
Right, sir.
Okay, if you're doing for 5, 10 years, market will not move in one direction. Market will be up and down. That's why doing SIP. If I
Right,
knew that the markets are always going to rise, why will I do an SIP? I will put lump sum, right? Okay, markets are going to go one way only. They're going to rise like a rocket only. It doesn't happen this way. Okay, markets went from 25,000 to 26,500 in 2 months. It crashed to 500 points today. That's what in SIP take the advantage average. Don't stop your SIP. Don't apply too much of your mind. Let the market do its own job. You continue with your SIP. You do not lose your sleep. Okay. You continue SIP, automatically arrive at an average and will go up provided you have a long-term horizon depending on your risk and goal profile. I do not know the name of the scheme. It depends on that also. But do not lose your sleep over that. Keep doing the SIP, inflation up and down will keep happening. Please don't look at that, please.
right. Okay.
Any other
So
question?
major, no, sir. Majorly we have covered the part now. If I miss any question, I'm just seeing that.
Yeah, just see some relevant question as well.
Yes, sir.
I'll answer one question if you don't mind. It's in front of me.
Yes, sir.
What are the difference between RIA, which I've already answered? Okay.
Right.
10A is an examination for becoming an RIA, please. Okay, that's nothing to do with. And NSM 21 is a PMS. Suppose anybody who promotes PMS, that's Portfolio Management Services, any distributor, any mutual fund employee, or any PMS employee who's selling mutual fund, they have to clear the PMS, not the investor. They have to clear the certification by NSM for PM, which is 21A. So don't get confused with that. Okay, please just answer on the aspect side. Yeah, Amit.
Right. So Sachin has asked, there is a scheme in mutual fund which is a combination of large plus mid cap. Why there is no combination of mid small or large small
It is
in
there now.
equity?
There are three schemes: are large, mid, and small. There are two types of scheme. One is a multi cap. One is a flexi cap. A multi cap scheme basically has a what do you call ceiling. 25% has to go to large cap. 25% has to go to mid cap. 25% has to go small cap. That's a multi cap fund. They cannot bust this 25%. Okay. Secondly, in a flexi cap also you can invest in you can invest in large, mid, and small cap. Irrespective of percentage, there the fund manager, according to the market, can invest higher in large cap or lower in small cap, or higher in small cap, lower in large cap, or lower in mid cap. He can take that call. There are two schemes which follow the strategy of investing in large, mid, small. There's a multi-cap and a flexi-cap. There are schemes available, and every mutual fund has both these schemes.
Right. So we have almost covered all the questions because majorly they are repetitive.
Sure.
So we can, we
Yeah,
are
yeah.
also running out of time. So questions are already covered. So on official note, I just declare this session that we have been completing now. So thank you so much, Sanjeev sir, for
Thank you.
today's webinar, taking
Thank you.
your time and patiently answering all the queries, because many people wants to invest in mutual fund, but they are not aware where to start, how to start. Then many questions have been asked by the today's attendees. I hope we have already cleared all their doubts. So thanks to the audience as well for attending today's webinar. And thank you, Sanjay sir, for patiently
My pleasure.
answering all the questions.
No issue. Thank you, Amir. Thank you so much.
Yeah.
Thanks.
Thank you so much, sir. Thank you so much. Have a nice day. Thank you,
You
sir.
too. Take care.
Thank you all the participants. Have a nice day.
Thank you.